When people hear a headline like Bitcoin is going to zero, their first instinct is often to laugh, dismiss, or run straight to the comments section to defend whichever side they already believe in. But Warren Buffett never speaks in headlines. He speaks in principles. He thinks in decades. And when he warns, he's not trying to predict the next quarter. He's trying to help you understand the next era. So when he says Bitcoin has no intrinsic value, when he repeats that all the enthusiasm in the world cannot turn a digital token into a productive asset, he's not trying to exaggerate. He's trying to remind you of something humanity keeps forgetting. Markets don't care about excitement forever. They always return to fundamentals, even if they take their time doing it. Imagine a candle burning in a quiet room. Its flame dances and flickers, sometimes rising, sometimes falling, but always drawing the eye. Bitcoin has been that flame for more than a decade, hypnotic, unpredictable, impossible to ignore. But Buffett's wisdom isn't about the flame. It's about the fuel. What keeps it burning, who keeps it burning, and what happens when the fuel runs out. That's the question he asks, not because he's rooting against innovation, but because he's seen more financial fires die than most of us have seen start. His perspective comes from living through every bubble modern investors study, not reading about them, not watching documentaries, living through them. From the moment he picked up Benjamin Graham's book in a dusty library to the years he spent watching investors pile into assets they never understood, Buffett learned one lesson repeated in 1,000 different ways. Price is what you pay, value is what you get. And Bitcoin, no matter how passionately defended or widely adopted, still struggles to explain what value it actually produces. This isn't an attack. It's an analysis shaped by almost a century of economic observation. It's the same kind of reasoning that helped him avoid the dot-com frenzy. Back then, the world was chasing something equally electrifying, websites that promised to reshape reality, companies with no profits, no clear path to revenue, and no durable competitive advantage were valued like modern-day empires. People said, "You just don't get it. This time is different." They laughed at Buffett. They called him old-fashioned. They said he didn't understand technology, and then, almost silently, the tide went out. The companies disappeared, the valuations crumbled, and the investors who believed excitement alone could support a business discovered a brutal truth. When the music stops, the people sitting on fundamentals survive. The people sitting on hype do not. Bitcoin supporters often point out that the dot-com crash didn't kill the internet. They're right, but it did kill thousands of companies built on dreams instead of economics. Buffett's warning isn't about whether blockchain is interesting. It's about whether Bitcoin, specifically, has the long-term characteristics that prevent collapse. When he says it produces nothing, he's pointing out that a currency with no backing, no cash flow, no dividends, no yield, and no intrinsic value depends entirely on the belief that someone in the future will pay more for it. That is the definition of speculation. And speculation, historically, has a painful habit of turning to dust when optimism fades. But Buffett isn't emotional about it. His tone is never panicked. It's calm, measured, almost patient, like a grandfather explaining that storms don't last because nature never lets imbalance survive forever. He knows people become attached to their investments. He knows they treat them like identity, not capital. He's watched investors fall in love with assets for generations. Railroads, radio companies, silver booms, uranium bubbles, housing manias, meme stocks, every era finds a new idol. The names change, but the psychology is identical. People want to believe they discovered the winning shortcut. They want to believe their era finally escaped the gravity of financial laws. And that's why his warnings feel uncomfortable. He's not arguing with Bitcoin's technology. He's arguing with humanity's tendency to confuse excitement with safety. Think of a man holding a balloon. He watches it rise higher and higher, believing its movement upward is proof of strength. But the balloon rises only because it is light, not because it is stable. If the wind stops, it floats. If the wind reverses, it falls. And if the material weakens even slightly, it bursts. Bitcoin's rise is impressive, but its rise is not the same as resilience. Its popularity is not the same as durability. Its volatility is not the same as growth. A currency that can lose half its value in a month is not a store of value. It's a wager. And wagers, no matter how thrilling, always end with someone holding the empty side of the bet. Still, the warning Bitcoin is going to zero isn't about the number zero itself. Buffett isn't predicting a specific price target. He's reminding people that in the history of global finance, assets with no intrinsic value eventually converge toward their true worth. That doesn't happen in a day. It happens slowly, quietly, beneath the surface. Confidence drips away, momentum fades, liquidity thins. And then a moment arrives, usually unexpected, when people realize the price is supported by belief alone. He has seen it before: South Sea companies, tulip bulbs, railways funded only by speculation, .com websites generating no revenue but massive excitement. Every one of them believed for a moment that economic laws had been rewritten. None survived unchanged. But Buffett never speaks with bitterness. He speaks with patience, like someone trying to save people from their own enthusiasm. He explains that risk isn't always loud. Sometimes risk is silent, invisible, disguised as excitement. The most dangerous investment is the one everyone believes cannot fail. Because when everyone believes that, no one notices the cracks forming beneath their feet. The cracks around Bitcoin are subtle: governments fighting for regulatory power, exchanges collapsing, hacks, scams, misplaced keys, vanished fortunes. A currency meant to represent ultimate security still depends heavily on unregulated platforms, technical knowledge, and centralized intermediaries people pretend are decentralized. Even the miners, the supposed backbone of the network, rely on cheap energy, expensive equipment, and unpredictable difficulty adjustments. If the economics shift even slightly, the miners disappear. And when miners disappear, so does the network stability that supporters claim is invincible. Buffett's perspective is simple: a financial system built on permanent uncertainty cannot replace a system built on centuries of evolving trust. Money is not just a tool, it's a belief system backed by law, stability, and enforced guarantees. Bitcoin's belief system is backed by code, anonymity, and mathematical scarcity, but scarcity alone does not create value. Sand is scarce on Mars. That doesn't make it valuable on Earth. Scarcity must be paired with utility, productivity, or cash flow. Bitcoin has none of those. It has only narrative. And narratives, Buffett warns, are the most fragile foundations of wealth. To understand his warning, imagine you're holding a share of farmland. Every year it produces crops. People eat those crops. Businesses buy those crops. You can measure the yield, forecast the output, estimate the future. Now imagine you're holding a bar of gold. It produces nothing, but it has thousands of years of cultural trust, industrial use, and universal acceptance. Now imagine you're holding a digital coin stored on a device that can break, on a platform that can fail, reliant on miners that can quit, dependent on demand that can vanish, and backed by nothing except a collective belief that it's worth something. Which one survives a crisis? Which one feeds families? Which one remains valuable when electricity stops, when markets panic, when liquidity evaporates? Buffett's calm voice would say, the answer is always the asset that does something, the one that works even when people stop believing. Bitcoin, he argues, does nothing, and when belief wavers, even slightly, the entire structure becomes vulnerable. Still, the warning isn't doom, it's discipline. Buffett doesn't want people to fear Bitcoin. He wants them to understand it, to see it not as a miracle but as a speculation, to treat it not as a guaranteed future but as a risky experiment. Because if you understand risk, you protect yourself. And protection, not prediction, is the heart of his advice. Over and over, he says the same thing: never invest in something you do not understand. Never confuse hope with value. And never assume the crowd is smarter than the numbers. Bitcoin's story is emotional. It attracts people with the promise of freedom, independence, outsized returns, rebellion against institutions. But markets do not reward emotion. They reward patience, clarity, and fundamentals. When Buffett warns that Bitcoin could one day fall to zero, he isn't telling you what will happen. He's telling you what can happen when an asset has no anchor. A boat without an anchor may drift far, but eventually it drifts too far. And yet he ends his warnings the same way he ends all his wisdom, with calm, with warmth, with reassurance. He isn't trying to scare anyone. He isn't trying to take anything from anyone. He's trying to give something: perspective. A perspective shaped by 90 years of watching the world chase excitement and later regret it. His message is simple: be careful, be thoughtful, be rational. And before you place your financial future in the hands of a volatile digital token, ask yourself the question he always asks. If the next buyer disappears, what do I truly own? And yet beneath all the noise, beneath all the passionate debates and the endless predictions, Buffett's voice remains steady, not because he dislikes innovation, but because he's learned that true financial wisdom lives in quiet truths, not loud promises. He doesn't blame people for being excited. He understands why they are. He understands the appeal of something new, something that feels revolutionary, something that seems to offer an escape from a financial world that often looks unfair or inaccessible. Bitcoin for many represents hope, independence, rebellion, empowerment. And hope is a powerful fuel, but hope by itself has never guaranteed safety. Buffett's warnings are never about stopping people from dreaming. They are about helping people separate the dream from the danger. Because when an investment is wrapped in emotion, when people tie their identity to it, they stop evaluating it logically. They stop asking the essential questions that prevent regret. Questions like, if this asset dropped 80% tomorrow, would it still serve a purpose? If regulation tightened, would it still function? If enthusiasm cooled, would anything remain? If the world shifted away from it suddenly, what would it still be worth? These are not dramatic questions. They are the foundational questions that every long-lasting asset can answer confidently. Bitcoin, Buffett argues, cannot. He often uses simple metaphors because simplicity, ironically, reveals truth more effectively than complexity. If you own the entire Bitcoin supply, every coin ever minted, what would you actually have? You couldn't use it to build something. You couldn't use it to feed someone. You couldn't use it to generate cash flow. You'd have something the world only values because the world says it does. He compares it to owning all the tulips in Holland during the tulip mania. If the world suddenly decided the flowers weren't valuable anymore, the entire fortune evaporated in an instant. That's the fragility he points to, not the technology, not the vision, the value structure itself. And history has shown, again and again, that assets built purely on belief endure only as long as the belief remains. The moment belief cracks, even slightly, the entire structure trembles. Bitcoin's faith-based value is its greatest strength during rallies and its greatest weakness during crashes. It climbs not because it produces, but because people expect it to climb. It falls not because it fails, but because people expect it to fall. And a system driven entirely by expectation rather than fundamentals is vulnerable to the smallest shift in sentiment. Imagine standing on a frozen lake. At first, the ice feels solid. You walk cautiously at first, then confidently. Others join you. Soon the lake is crowded and everyone says, "Look at all these people. The ice must be strong." But the strength of the ice doesn't come from the number of people standing on it. It comes from the thickness you cannot see. Bitcoin's believers point to the crowd as evidence of safety. Buffett points to the ice. He asks what lies beneath the surface, what supports the confidence, what ensures the stability when the temperature changes. And when he examines Bitcoin, he sees a surface crowded with people, but he cannot find the thick layer beneath that guarantees survival. He knows how quickly markets can turn. He knows fear moves faster than optimism. He knows that in moments of panic, liquidity dries up, trust evaporates, and the assets built on the weakest foundations fall the hardest. It doesn't matter how popular they were the day before. Popularity does not cushion a collapse. Fundamentals do, and this is why his warning carries such weight. He's seen the collapse pattern so many times that he can recognize it long before most people see the first cracks forming. Still, Buffett never mocks Bitcoin investors. He never belittles them. He simply urges them to think, to ask themselves what they are actually buying. To imagine the world 20 years from now and ask whether Bitcoin's value endures in that world or whether it becomes a historical curiosity. Because if the only explanation for its value is that others believe in it, then that belief must remain flawless forever. And no belief in financial history has ever remained flawless, especially one not tied to productive output. He often reminds people that money itself, real money, national currency, is valuable because governments enforce its acceptance. You owe taxes in it. You settle debts in it. You buy necessities with it. Bitcoin, on the other hand, relies on voluntary adoption, voluntary enthusiasm, voluntary trust. And voluntariness, while noble, is fragile. It cracks under pressure. It bends under uncertainty. It collapses under regulation. A currency that depends on voluntary trust cannot replace a currency backed by enforced necessity. But Buffett's greatest concern isn't price. It isn't technology. It's human behavior. He understands that investors rarely lose money because they choose the wrong assets. They lose money because they don't understand the risk they're accepting. They don't understand themselves. They don't understand their own emotional thresholds. Bitcoin's volatility is a test of psychology more than economics. People claim they can stomach the swings until the swings arrive. They claim they believe in the future until the present terrifies them. And when fear takes hold, even the strongest convictions weaken. Buffett often says you don't know who's swimming naked until the tide goes out. Bitcoin's tide cycles are dramatic. When the water is high, when charts glow green, when influencers celebrate new highs, everyone feels like a genius. Everyone feels secure. Everyone feels early. But when the tide pulls back, when collapses happen overnight, when exchanges freeze withdrawals, when rumors spread, when fear turns into a chain reaction, suddenly people discover how exposed they truly were. That's the moment Buffett warns about, not the highs, the lows, the silent hours when belief becomes doubt and doubt becomes panic. He isn't predicting Bitcoin's destruction. He's warning about its vulnerability. Vulnerability created by the absence of intrinsic value, the reliance on sentiment, the exposure to regulation, the dependence on miners, the fragile ecosystem surrounding it. It is a system built on hope, empowered by technology, but untethered to fundamentals. And systems like that can climb astonishingly high before gravity reasserts itself. But even as he warns, he remains gentle. He knows that dismissing Bitcoin outright closes the door to understanding, and understanding is what he values most. He wants people to understand why something rises, why something falls, why some assets endure and others disappear. Because the moment you understand these patterns, you stop fearing markets. You stop chasing shortcuts. You start building wealth the way trees grow, slowly, naturally, supported by roots. Bitcoin, in his view, has branches but no roots. Beautiful branches, impressive branches, branches the world admires. But without roots, even the tallest tree falls in the first real storm. And storms always come, they always have, they always will. Yet he never ends on despair. He ends on responsibility, on the quiet, steady reminder that you, not the market, not the charts, not the influencers, are responsible for understanding what you own. If you choose Bitcoin, choose it with clarity, not hope. Understand what it is, what it isn't, what it can be, what it cannot be. Approach it the way he approaches every investment, with patience, humility, and a willingness to face truth rather than excitement. Because the real warning isn't that Bitcoin will go to zero. The real warning is that investors who don't understand why an asset rises are often the ones most hurt when it falls. Buffett isn't predicting doom. He's offering a flashlight in a dark room, a calm voice in a noisy world, a reminder that financial storms do not care how confident you were yesterday. They only care how prepared you are when the winds change. And the winds, in his experience, always change. And so the narrative continues, drifting forward with the same calm gravity, the same thoughtful cadence, as if Buffett himself were leaning back in his chair, hands folded, offering wisdom not to overpower you but to steady you. Because what he understands better than anyone is that markets are emotional organisms. They breathe, they panic, they relax, they celebrate, and they forget. Especially forget. And forgetting is often what leads investors into danger long before the danger itself arrives. Bitcoin's rise over the years has created a comforting illusion, the illusion that volatility is normal if the price eventually recovers. People see the dramatic drops, the winter cycles, the collapses of exchanges, the scandals, the hacks, and yet they return to a single comforting thought. It bounced back last time, so it will bounce back again. It's a form of collective memory, loss disguised as resilience. But Buffett would gently remind you that past rebounds don't guarantee future safety. They guarantee only that people once believed enough to rescue the price. The future, however, does not owe anyone another rescue. He has watched this pattern for decades across countless manias. The railway bubble of the 1800s, the conglomerate boom of the 1960s, the silver mania of the late 70s, the Japanese asset bubble of the 80s, the dot-com explosion of the 90s, the housing mania before 2008, the meme stock fever of recent years. All of them felt invincible at their peak. All of them were filled with people who said, "It recovered last time." All of them created communities convinced that they were early pioneers in a guaranteed revolution. And all of them were humbled by the same truth. An asset without a stable foundation can only defy gravity for so long. Bitcoin's foundation is belief. It is elegant belief, technologically wrapped, decentralized, mathematically precise, but belief nonetheless. A belief that the algorithm ensures scarcity, a belief that decentralization ensures safety, a belief that adoption ensures permanence, but beliefs are not the same as cash flows. They are not the same as ownership. They are not the same as productive value. And Buffett's lifetime of investing has taught him one simple reality: belief is the most unstable foundation in finance. It can expand quickly, but it can contract even faster. To illustrate this, Buffett often turns to stories, not because he wants to entertain, but because stories anchor ideas in memory. He might remind you of the time people paid absurd prices for seashells in ancient cultures, or the time gold prospectors believed the earth would never run out of easy gold, or the time investors once paid fortunes for railroad companies that never laid a single mile of track. In every case, the story followed the same arc. A new idea captured imagination, early investors made spectacular gains, momentum grew, the narrative hardened, skeptics were dismissed, and then, quietly, almost invisibly, the fundamentals failed to justify the prices. The collapse always felt sudden, but it never truly was. The seeds had been planted long before. People simply chose not to see them. Bitcoin, he warns, may follow the same script, not because it is evil, not because it is foolish, but because it is vulnerable. It lives in a world where regulators are sharpening their tools, where governments want control, where exchanges act as central points of failure, where large holders, the so-called whales, can shift markets with a single move, where miners face rising costs, energy battles, geopolitical instability. Where enthusiasm fuels runs upward, but fear accelerates crashes downward. A system built on code still depends on the behavior of humans, and humans are inherently unpredictable. Buffett would tell you about the people he's known who lost fortunes not through malice or stupidity, but through the simple act of believing too deeply in something they never fully understood. He has seen brilliant minds crumble under the weight of optimism. He has watched confident investors cry as markets erased everything they built. He has seen quiet warnings ignored until it was too late. And he shares these memories not to scare, but to educate. Because risk is never obvious when enthusiasm is high. Risk hides beneath celebration. It waits in the shadows of euphoria. Bitcoin offers extraordinary potential for gains, but extraordinary gains require extraordinary vulnerability. The higher the climb, the thinner the oxygen, the more painful the fall. Bitcoin's volatility is not a flaw in Buffett's view. It is a signal that the asset has no anchor, that it floats freely on winds of sentiment, that it can swing wildly because nothing holds it steady. A productive asset is like a tree rooted in the ground. It may sway, but it rarely snaps. A speculative asset is like a kite. It flies beautifully until the wind shifts. Yet despite everything, Buffett never says people must avoid Bitcoin entirely. He never tells people what they should or shouldn't buy. Instead, he repeats the same gentle warning: understand what you own, understand why it goes up, understand why it goes down, understand the psychology behind it. Because most people, when they say they believe in Bitcoin, actually believe in the feeling Bitcoin gives them. The feeling of being early, the feeling of being part of something revolutionary. The feeling of having found a shortcut. And feelings, he knows, are powerful, but they are not safe investment strategies. He explains that true wealth is built quietly, slowly, predictably. It grows like a snowball rolling down a long hill, small at first, then gradually compounding into something extraordinary. Bitcoin, by contrast, grows like fire, fast, bright, attention-grabbing, but consuming its fuel quickly and unpredictably. Fire can warm you, but it can also burn you. Snow, however, only grows larger the longer it rolls. Buffett's philosophy is not exciting, it's not trendy, it's not viral, and that's precisely why it works. It survives every bubble, every mania, every technological shift, because it isn't based on fashion, it's based on reality. When he warns that Bitcoin could go to zero, he isn't predicting its imminent destruction. He's reminding you that its entire value is belief-driven, and belief-driven assets have historically collapsed when confidence fades. Even if they bounce back afterward, the crash can be devastating for those who didn't prepare. Imagine a quiet room. Two people sit across from each other. One holds a Bitcoin wallet. The other holds a share certificate for a company producing thousands of units of something the world needs. One asset is backed by belief, the other by output. Buffett asks, which one survives a crisis? Which one pays you while you sleep? Which one endures when fashion changes, when governments intervene, when markets freeze? The answer in his mind is obvious. And that simplicity is what confuses people. They want the future to be complicated, dramatic, groundbreaking. They want wealth to arrive quickly. But he teaches that wealth arrives slowly, predictably, quietly, usually without drama at all. And so the warning continues, not as thunder but as a whisper, a reminder that the financial world has rules, and the rules do not bend for enthusiasm. An asset must produce, it must generate, it must give something back. Otherwise, it is a trophy, admired, traded, speculated on, but ultimately hollow. But even as he offers this caution, there is no bitterness in his voice, no judgment, only understanding, because he knows that every generation must learn the lessons he learned. Some learn through wisdom, others learn through pain. His hope always is to help people choose wisdom. And so the story unfolds further, flowing in Buffett's measured cadence, calm and reflective, like a quiet lecture in a sunlit study lined with ledgers and books. Because what he teaches is timeless. The heart of investing is not in chasing miracles, it is in recognizing reality. And reality over centuries has repeated itself in patterns that never truly change. Bitcoin, in all its modern brilliance, is not exempt from those patterns. Its innovation is remarkable. Its allure is undeniable. But innovation does not equal permanence. All the novelty in the world cannot replace fundamentals. Buffett would remind us that human behavior is the ultimate variable in finance. Technology can be flawless, algorithms can be perfect, but humans are rarely rational and they are never perfectly predictable. When excitement surges, caution diminishes. When fear strikes, rationality evaporates. Bitcoin's rise has been fueled by hope, optimism, and sometimes irrational exuberance. Its volatility, far from being a bug, is a reflection of human psychology writ large across a digital ledger. And human psychology, as history shows, is the most dangerous of all market forces. He often speaks of the crowd mentality, the invisible hand that can elevate an asset to heights it does not deserve. And yet that same crowd, driven by panic or disillusionment, can drag it down just as ruthlessly. When the crowd abandons an asset, even temporarily, the collapse can be catastrophic. For Bitcoin, whose value is derived almost entirely from collective belief rather than productive output, the stakes are magnified. A sudden loss of confidence, a regulatory intervention, a technical failure, or even a rumor can trigger reactions far out of proportion to the underlying system, because there is no intrinsic buffer to absorb the shock. Buffett's calm reasoning often incorporates metaphor, because metaphors clarify the invisible. He might ask you to picture a balloon. Tethered to the ground by nothing but a string, the balloon rises magnificently when the wind is favorable, admired by everyone who sees it. Yet the slightest cut to the string or gust of wind can send it plummeting. Bitcoin in his framework is much the same. Its rise is impressive, almost hypnotic, but the underlying tether, the mechanism holding value in place, is fragile. And history shows that when tethers fail, consequences are swift and often irreversible for those unprepared. But his warnings are never purely negative. They are instructive. He is teaching, not predicting. He asks investors to recognize that the same qualities that make Bitcoin exciting, its decentralization, its scarcity, its technological elegance, are not sufficient to ensure stability or safety. They cannot replace cash flows, earnings, or productivity. They cannot replace fundamentals. They can create spectacular gains for some, but they can also create sudden, devastating losses for the unwary. And Buffett's voice, calm and authoritative, reminds investors that the difference between a speculative frenzy and sustainable wealth is discernible if you look closely. He would ask you to consider liquidity. In traditional assets, if a crisis arises, markets exist to absorb shocks. Stocks, bonds, commodities, they have depth, and even in panic, they tend to reflect underlying value to some degree. Bitcoin, by contrast, can experience dramatic swings in liquidity. Exchanges can freeze, orders can evaporate, volumes can collapse. The price can swing wildly not because fundamentals have changed, but because human participants react in fear. And fear, as Buffett has repeatedly observed, is more powerful than hope. Moreover, he emphasizes that risk is not merely about potential loss, but about exposure to uncertainty you cannot control. With Bitcoin, so much is uncertain: the regulatory environment, the security of digital wallets, the behavior of large holders, the energy costs of mining, the adoption curve, and technological vulnerabilities. All of these factors can change suddenly, and all of them are beyond the control of the individual investor. A responsible investor, in Buffett's view, recognizes that risk is not always visible in charts or headlines. It is embedded in the structure of the asset itself. He often contrasts this with investments in productive assets. Owning a piece of a company producing something the world needs creates inherent value. Even if markets fluctuate, the underlying output continues. Dividends are paid, revenues accrue, cash flows exist. Those are buffers against disaster. They are anchors in storms. Bitcoin has none of these anchors. Its appeal is entirely psychological, entirely based on perception and collective belief. And when perception falters, the consequences can be severe. Buffett's style is calm because he wants understanding, not fear. He encourages reflection. He encourages measured assessment. He wants investors to see clearly rather than be swept away by emotion. He knows that in times of euphoria, warnings are ignored, but when markets contract, the lessons are learned harshly. He prefers that people learn lessons before the contraction, not after. His advice is always proactive. Think, understand, evaluate. Ask hard questions. Examine your assumptions. Consider what you are truly buying, not what you hope it will become. He would remind investors that markets are patient teachers, but brutal in their instruction. Bitcoin's story may continue to rise for months or years. That is possible. But Buffett's concern is what happens when the inevitable correction arrives. Every mania in history, no matter how innovative or alluring, eventually reached a point where enthusiasm alone could not support the valuation. The greater the speculative fervor, the more violent the contraction when reality asserts itself. This is not prophecy, it is observation. He also cautions against herd mentality. People buy Bitcoin because others buy it. They defend it because others defend it. They ignore warnings because the crowd ignores warnings. Yet history shows that the herd is rarely right at the peak of excitement. Wisdom often resides in quiet analysis, patience, and skepticism. Recognizing this distinction, Buffett teaches, is more valuable than chasing the latest trend or the most rapid gain. Because trends are ephemeral, understanding endures. Buffett's ultimate point is that value must be grounded. Bitcoin is beautiful in design, elegant in technology, and fascinating in social impact. But beauty and fascination do not guarantee durability. They do not pay bills. They do not generate cash flows. They do not produce goods or services. And history tells us that assets which produce nothing are inherently vulnerable to collapse when human confidence wavers. That is the essence of his warning, a reminder to invest with eyes open, with patience, with wisdom, and with humility. And in the end, his voice remains calm, measured, unshaken. He does not seek to inflame or scare. He seeks to illuminate. He seeks to guide. The lesson he imparts is consistent. Understand what you hold, know why it has value, recognize the risks, and never rely solely on hope. Bitcoin may soar, Bitcoin may dazzle, Bitcoin may inspire. But the principles of finance, the laws of economics, and the patterns of human behavior remain constant. And Buffett, with decades of quiet observation, reminds us that ignoring these constants is perilous. And as we reflect further, it becomes clear that Bitcoin is more than just an asset. It is a mirror to human psychology. It magnifies our impulses, our fears, our desires, and our belief in miracles. Buffett sees this mirror and warns not because he wishes to shatter dreams, but because he knows how often reflections can deceive. The allure of Bitcoin is in its story, the story of a revolution, a decentralized future, freedom from institutions, the promise of wealth untethered to rules. But stories, while captivating, are not guarantees. They inspire action, but they do not produce stability. They are ephemeral, delicate, and dependent on the collective faith of participants, and history teaches that such collective faith, no matter how widespread, can be fragile. Buffett would invite us to consider patience as an asset in itself, the patience to wait, to observe, to question before acting. In his view, impulsive decisions, especially those driven by excitement, are rarely profitable in the long term. Bitcoin has offered stunning profits to those who entered early and exited at the right time, but it has also erased fortunes for those who relied solely on momentum and narrative. The calm investor, the patient observer, measures risk not by recent gains, but by the durability of underlying value. And that is why his calm voice resonates even amid the chaos. It reminds us that survival is more valuable than exhilaration. He would also point to the paradox of innovation and risk. Bitcoin represents technological genius, yet genius alone does not shield an asset from collapse. Innovation can create opportunity, but it cannot replace stability. Buffett has repeatedly emphasized that the world is full of brilliant ideas that never produced sustained wealth. Railways promised connectivity, radio promised communication, .com companies promised revolution. Many succeeded, some thrived, but countless others failed spectacularly. The difference lay not in imagination, but in enduring value creation. Bitcoin, fascinating as it is, remains untested across the full spectrum of crisis, and that uncertainty is its most profound risk. Furthermore, Buffett's reasoning often returns to simplicity. He breaks complex ideas into questions any rational investor can ask. Does this asset produce something tangible? Can it withstand stress? Is it dependent on faith alone? Can it continue to provide value if enthusiasm wanes? Bitcoin, he argues, struggles to answer these questions convincingly. Its scarcity and mathematical integrity are elegant, but elegance does not feed a family, does not generate dividends, does not create employment. It is an engine of speculation, not production, and speculation, in his long view, is inherently more fragile than production. Buffett would remind investors that volatility, while exciting, is often a warning sign disguised as opportunity. High volatility can create immense short-term profits, but it can also wipe out capital rapidly. Markets are forgiving to the disciplined investor, but harsh to the unprepared. Bitcoin's swings are not random. They reflect the very structure of its existence, belief-dependent, sentiment-driven, and sensitive to factors beyond the control of individual holders. Recognizing this, Buffett encourages reflection rather than reaction, observation rather than obsession, understanding rather than hope. He often draws comparisons to physical assets to make the principle tangible. Owning a factory producing essential goods is like owning land planted with perennial crops. It grows steadily, even amid storms, providing yield and security. Owning gold is like holding a mineral with industrial and cultural significance. It is scarce, tangible, and historically recognized as valuable. Owning Bitcoin is like holding a complex, invisible instrument whose value exists only as long as collective belief persists. The metaphor illustrates the fundamental difference between assets that produce and assets that inspire belief. Buffett urges investors to appreciate this distinction deeply, because ignoring it is the path to unforeseen loss. Buffett also emphasizes the importance of perspective over excitement. Many people enter Bitcoin not because they understand it, but because they see others making fortunes. Herd mentality, the fear of missing out, and the allure of rapid gains often overshadow rational assessment. Buffett warns that these forces are not new. They are recurring features in every financial mania. They appear as innovative, modern, and extraordinary, but underneath lies the same human behavior: greed, optimism, and the tendency to underestimate risk. The lesson is timeless. Recognize human bias, question assumptions, and evaluate the true foundation of any asset before committing your capital. He would also stress that regulatory risk cannot be overlooked. Governments are not passive observers. They shape currency, enforce laws, and regulate markets. Bitcoin operates in a space that is simultaneously celebrated and scrutinized, decentralized yet dependent on exchanges, miners, and digital infrastructure. Any intervention, however minor, can have outsized consequences. The fragility is not technological, it is structural and systemic. Buffett understands that stability is not a function of design alone. It is a function of resilience in the real world under real stress, when humans interact with assets in unpredictable ways. In his quiet, deliberate style, Buffett often highlights the contrast between fascination and utility. People are fascinated by Bitcoin's rise, by its decentralization, by its technological elegance. They marvel at the speed of transactions, the ingenuity of blockchain, the potential for freedom from centralized institutions. But fascination is not a shield. Utility is. Assets that perform, that deliver consistent results, that withstand crises survive. Assets that merely inspire, that depend on belief alone, are vulnerable. And vulnerability, he reminds us, is the risk every investor must measure before acting. He often likens investment to sailing. Calm seas and favorable winds create a sense of mastery, but true skill is revealed during storms. Bitcoin has sailed through exuberance, innovation, and adoption, yet it has never fully weathered a crisis of confidence on the scale Buffett has observed in traditional markets. And markets eventually test every asset, every investor, every belief. The storms arrive, inevitably. The question is whether the vessel is prepared or merely buoyant on hope. Buffett's caution is not pessimism, it is preparation. Even as he warns, Buffett's wisdom remains reassuring. He does not claim that Bitcoin will fail tomorrow or even next year. His guidance is timeless. Understand what you own, assess its vulnerabilities, and measure your own capacity for risk. The market does not need to destroy an asset to prove a point. Sometimes it only needs to reveal the limits of human confidence. And recognizing those limits is the essence of prudent investing. Bitcoin's allure is undeniable, but its fragility is equally real. That duality, carefully considered, forms the core of Buffett's advice. Buffett's ultimate counsel is patience, reflection, and discipline. Wealth is rarely created in moments of frenzy. It is cultivated in quiet, thoughtful observation. Bitcoin may offer spectacular gains to some, but it can also expose those unprepared to dramatic losses. The volatility, excitement, and narrative allure make it tempting, but temptation is not the same as value. Understanding, discipline, and clarity are the hallmarks of enduring investment. And that is what Buffett offers. The clarity to distinguish between spectacle and substance, between momentary hype and lasting value, between belief and reality. He concludes always with calm reassurance. Financial storms are inevitable, but knowledge and preparation offer protection. By understanding the principles, observing history, and recognizing human behavior, investors can navigate uncertainty with composure. Bitcoin's story is compelling, its technology revolutionary, its potential significant, but its foundation, according to Buffett, remains untested in the crucible of lasting stability. And recognizing that is the first step toward protecting oneself, toward making prudent decisions, and toward approaching markets with wisdom rather than blind enthusiasm. Buffett would also urge investors to consider the emotional cost of owning something as volatile as Bitcoin. It is not just financial risk that matters, it is psychological endurance. Holding an asset whose value can swing dramatically overnight tests patience, discipline, and self-control. Many investors underestimate this burden. The sudden drops, the flash crashes, the rumors, the headlines, they do not only affect the market, they affect the mind. Buffett understands that stress, fear, and anxiety can lead to poor decisions far more quickly than market fundamentals ever could. An asset that produces nothing but stress is costly, regardless of its nominal price. Wealth is not measured solely in numbers. It is measured in peace of mind, in confidence, in the ability to sleep well while the world changes around you. And Bitcoin, by its nature, challenges that serenity. He would compare this to the discipline required in traditional investing. Owning a well-managed company, a diversified portfolio, or a productive asset allows the investor to focus on long-term performance, confident that fundamentals will support the price over decades. Bitcoin does not offer that reassurance. Its value depends on the collective sentiment of participants, which is capricious and often irrational. Every spike in price invites speculation, every crash invites panic, and every news headline can trigger reactions that bear little relation to intrinsic worth. Buffett warns that this environment favors those who thrive on emotion and luck, not those who seek consistency and stability. Buffett also emphasizes the importance of understanding opportunity cost. Every dollar invested in Bitcoin is a dollar not invested in assets that produce something tangible or provide consistent returns. Over time, this opportunity cost compounds. Investors chasing speculative gains may achieve temporary windfalls, but they may also miss the slower, steadier growth of productive investments. Wealth, in Buffett's experience, is built not in leaps of excitement, but in cumulative advantage, the slow accumulation of assets that generate income, dividends, and real value over time. Bitcoin, while potentially spectacular, does not inherently create this type of long-term growth. He would also remind investors that bubbles are often disguised as revolutions. Bitcoin enthusiasts celebrate decentralization, innovation, and disruption, and indeed these qualities are compelling. Yet, Buffett has observed that every mania in history has been framed as revolutionary at the time. Railroads, electricity, the telegraph, radio, the dot-com boom, every era saw its own innovation heralded as the future. Many of those technologies ultimately transformed the world, but most of the associated speculative investments did not survive the hype. The lesson is that disruption alone is insufficient to guarantee value. Products must produce, companies must deliver, and investments must have durability beyond human excitement. Bitcoin's innovation is impressive, but its survivability under stress remains untested. Buffett often illustrates these principles through metaphor. He might describe a hot air balloon rising beautifully into the sky. The view is stunning, the ride exhilarating, yet it is tethered only by belief and wind. There is no solid foundation, no ballast of productive output to stabilize it. The higher it rises, the more exhilarating the journey, but the greater the risk if the tether fails or the wind shifts. The higher Bitcoin climbs, the more spectacular the potential gains, but also the more exposed it becomes to sudden collapse. And when collapse comes, there is no anchor to soften the fall. That is the essence of Buffett's caution. He would also point out that history favors patience over impulse. Great fortunes are rarely created by riding speculative waves. They are built by holding durable, productive assets over decades, reinvesting returns, and letting time compound value. Bitcoin's meteoric rise tempts investors to chase short-term gains rather than build lasting wealth. The excitement of dramatic returns obscures the reality that wealth is measured over decades, not days. The calm investor, Buffett insists, understands that the true risk lies not in missing a rally, but in losing everything during a panic. Furthermore, Buffett emphasizes that understanding the underlying mechanics of an asset is crucial. He does not dismiss Bitcoin because he dislikes technology. He dismisses it because its underlying mechanics do not generate intrinsic value. The blockchain is elegant. The mathematics are precise, yet these qualities do not produce cash flow, dividends, or productive output. They create scarcity, a digital ledger, and an illusion of security. Scarcity is not value, and security without utility is fragile. Investors must separate fascination from fundamentals, technology from production, belief from true economic contribution. This distinction is at the heart of Buffett's warnings. He also stresses the importance of long-term thinking. Markets are unpredictable in the short term, but they follow patterns over decades. Assets that produce tangible results, that generate income, that solve real problems, survive crises and compounding cycles. Assets that depend purely on sentiment, by contrast, are exposed to sudden shifts in confidence. Bitcoin's allure comes from its recent history of spectacular gains, yet this history does not insulate it from future shocks. Buffett reminds investors that true wealth is measured over decades, not in headline-grabbing rallies. Understanding this timeline is essential to making prudent decisions. Buffett would caution against conflating popularity with permanence. An asset may be widely celebrated, widely adopted, and widely speculated upon, yet these factors alone cannot ensure survival. Popularity can create short-term liquidity and excitement, but it cannot create intrinsic value. The key distinction, he teaches, is between assets that produce and assets that impress. Bitcoin impresses with its story, its design, and its narrative, but it produces little beyond speculative potential. And history demonstrates that assets with little production are highly vulnerable when sentiment shifts, when fear replaces hope, or when external pressures intervene. He also highlights the role of external forces in shaping outcomes. Governments, regulators, technological developments, market participants, and global economic trends all influence Bitcoin's trajectory. These forces are unpredictable, often beyond the control of any single investor, and capable of triggering volatility far beyond what is rationally anticipated. Buffett stresses that understanding and preparing for these forces is part of responsible investing. Ignoring them, or relying solely on optimism, exposes investors to risks that are avoidable, yet often underestimated. Ultimately, Buffett's guidance centers on clarity and rationality. Investing is not a game of excitement. It is a disciplined process of evaluation, risk management, and long-term planning. Bitcoin is a fascinating technological phenomenon and a cultural force, yet it challenges the principles that have sustained wealth across centuries. Its value is fragile because it relies entirely on belief, subject to human psychology, regulatory change, and market sentiment. Buffett's calm warning is that without understanding, without preparation, and without a recognition of underlying risks, investors are exposed to outcomes they may not anticipate until it is too late. And through it all, his voice remains steady, measured, and patient. He does not seek to frighten, he seeks to illuminate. He offers perspective over panic, reasoning over emotion, and observation over speculation. Bitcoin may rise, Bitcoin may inspire, it may change aspects of finance and culture. Yet Buffett reminds us that the same principles that governed markets a century ago remain true today. Value is measured by production, durability, and resilience, not by excitement, narrative, or collective belief. Understanding these principles, he teaches, is the key to surviving volatility, navigating speculation, and ultimately building enduring wealth. Buffett would also urge investors to consider the intangible cost of speculation. It is not only money at stake, but attention, focus, and peace of mind. Obsessing over an asset that fluctuates wildly diverts energy from productive investments, from thoughtful decision-making, and from long-term planning. Time, after all, is one of the most valuable resources an investor has. Spending it watching charts, reading hype, or reacting to social media sentiment compounds stress without producing returns. He often reminds people that wealth is created not in reaction to every twist and turn of the market, but in the quiet patience to hold, evaluate, and compound value over time. Bitcoin, by its very nature, tests that patience continuously. He also stresses the importance of resilience. Durable investments withstand storms because they have roots, fundamentals that anchor them regardless of temporary turbulence. Bitcoin, by contrast, lacks that grounding. Its strength is its popularity and belief, which are inherently fleeting. A single shift in perception, a change in regulation, a technological flaw, a loss of confidence among major holders can trigger outsized consequences. Buffett teaches that true resilience is measurable and tangible. Cash flows, productive assets, diversified portfolios, and income streams create stability. Belief alone, however widespread, is fragile. Buffett would likely remind investors to separate fascination from investment. The brilliance of Bitcoin, its decentralized architecture, its finite supply, and its potential for transformation are undeniably fascinating. Yet fascination does not guarantee financial safety. One may marvel at the artwork of a gallery, but admiring a painting does not provide food, shelter, or income. Similarly, admiring Bitcoin's ingenuity does not guarantee the preservation or growth of wealth. Investing requires distinguishing between admiration and utility, between excitement and durability, between the thrill of a story and the assurance of fundamentals. He often uses historical analogies to make these points vivid. The South Sea bubble in the 18th century, the tulip mania in the Netherlands, the railroad mania in the 19th century, each captivated the public imagination with promises of limitless wealth. Each relied heavily on collective belief, and each collapsed when confidence faltered. The lessons were not lost to history, yet human behavior repeated them. Buffett's warnings about Bitcoin are not unique. They are part of a continuum, rooted in centuries of observation, revealing a consistent truth. Assets without intrinsic productivity, regardless of novelty or excitement, are highly vulnerable to the whims of sentiment. He also emphasizes the difference between innovation and reliability. Bitcoin is undeniably innovative. Its underlying technology represents a significant advancement in cryptography, distributed systems, and digital ledger management. But innovation alone does not produce revenue or provide a safety net. Buffett's experience teaches that the most successful investments are rarely the most exciting or novel. They are the ones that produce, that solve real-world problems, and that endure under pressure. Bitcoin's innovation fascinates, but its capacity to endure financial storms remains unproven. Buffett frequently highlights the psychological dimension of investing. Humans are prone to overconfidence, optimism bias, and herd behavior. Bitcoin amplifies these tendencies because it offers stories of rapid gains and community validation. The risk is not in the technology itself, but in how humans interact with it. Fear can trigger a collapse just as quickly as excitement can fuel a rise. Understanding human psychology, therefore, is as critical as understanding financial fundamentals. Buffett's calm voice repeatedly points to this reality. The market is not just a reflection of mathematics or technology, but of human behavior, which is often unpredictable and extreme. He also underscores the importance of clarity over hype. Many investors enter Bitcoin with partial understanding, guided by headlines, social media, and anecdotal success stories. Buffett insists that responsible investing requires full comprehension of the asset, its mechanics, and its risks. This includes understanding volatility, the potential for complete loss, technological vulnerabilities, regulatory threats, and dependency on collective belief. Without clarity, excitement becomes recklessness. Without understanding, hope becomes exposure. And Bitcoin, in its current structure, demands both extraordinary knowledge and extraordinary courage to navigate safely. Buffett would remind investors to focus on what can be measured and controlled. Traditional investments, stocks, bonds, real estate, productive companies, offer quantifiable cash flows, established markets, historical performance, and legal protections. Bitcoin's value, while quantifiable in market price, is not inherently tied to productivity. It is dependent on adoption, sentiment, and speculation. This distinction is critical because measurable factors provide a basis for rational decision-making, whereas speculative factors invite emotional reaction. The disciplined investor, Buffett insists, prioritizes predictability and control over excitement and uncertainty. He also often contrasts short-term excitement with long-term durability. Bitcoin's price fluctuations may be dramatic, producing temporary wealth for early entrants or lucky participants. Yet wealth built on volatility without underlying productivity is inherently precarious. True financial success is cumulative and long-term. It is built on assets that continue to perform and generate returns regardless of temporary sentiment. Buffett's guidance encourages investors to view Bitcoin's history not only in terms of its highs, but in terms of its resilience under stress, a test it has yet to face comprehensively. Buffett frequently reminds investors that history repeats because human behavior is consistent. Markets are shaped not by the novelty of technology, but by the constancy of human greed, fear, and overconfidence. Bitcoin, like past speculative frenzies, is a modern reflection of these age-old dynamics. Its digital form, blockchain architecture, and decentralized philosophy are new, but the underlying forces of risk, sentiment, and human psychology remain the same. Recognizing this continuity is essential for evaluating both the potential and the vulnerability of any asset. Ultimately, Buffett's wisdom is not pessimistic, it is instructive. Bitcoin may continue to rise, it may inspire new financial paradigms, it may transform parts of global finance, but its foundation is not rooted in the production of tangible value. Its volatility is extreme. Its reliance on collective belief creates inherent fragility, and understanding these truths is essential for any investor seeking not only profit, but preservation, discipline, and long-term security. Buffett's calm, measured voice is not a warning of inevitable doom. It is a call to awareness, reflection, and prudent action. And through it all, his narrative returns to the core principle. The value of an asset is not in its story, its hype, or its beauty. It is in its capacity to produce, to endure, and to survive human error and market turbulence. Bitcoin fascinates, it dazzles, it challenges convention. But for the patient, disciplined investor, its brilliance is secondary to the reality that enduring wealth relies on production, stability, and clarity, not excitement. Buffett would also reflect on the concept of inevitability in financial markets. No asset, regardless of innovation or popularity, is immune to the forces of reality. History teaches that markets have cycles, and cycles expose both strength and weakness. Bitcoin's meteoric rise captures imagination, but every rise contains the seeds of a future test. The very factors that drive its ascent, speculation, belief, enthusiasm, also set the stage for potential reversal. Buffett's counsel is to recognize that the extraordinary gains of today do not erase the vulnerabilities that can lead to tomorrow's losses. He often reminds investors that true understanding comes from observation over time. Watching markets, studying history, analyzing behavior, these are the tools of prudent investment. Bitcoin's story is still young in historical terms. Its resilience in the face of a complete systemic shock remains unproven. Every investor, Buffett would argue, must ask, can I endure the worst-case scenario? Can I maintain clarity, patience, and rationality if sentiment collapses and the price plunges? The answer to these questions defines risk far more than any short-term rally ever could. Buffett would also emphasize the value of perspective. Temporary losses, short-term excitement, or rapid gains are fleeting in the span of decades. Wealth is measured in consistency, durability, and the ability to weather storms without panic. Bitcoin's volatility amplifies human emotion, and emotion can drive irrational decisions more effectively than any market event. By viewing the asset through a lens of long-term principles rather than momentary excitement, investors gain clarity about both opportunity and exposure. He frequently contrasts speculation with ownership of productive assets. Owning a stake in a company that produces goods, delivers services, and generates revenue provides a measurable foundation. Even if the market price fluctuates, the underlying value persists. Bitcoin, by contrast, depends largely on the continuation of faith, sentiment, and collective belief. The absence of tangible production makes it uniquely sensitive to shifts in confidence, technological challenges, or regulatory interference. Buffett's warning is that assets that rely primarily on sentiment are exposed to forces far beyond the investor's control. He would illustrate this further with metaphor. Imagine a castle built on sand. It may rise high and impress all who see it. Its towers may glitter in sunlight. Visitors may marvel at its architecture. But when the tide comes in or the storm strikes, the castle's foundation cannot hold. Bitcoin, Buffett suggests, has towers of brilliance and a glittering narrative, but its foundation, rooted in belief rather than production, is less secure than most realize. Preparing for the potential storm is not pessimism, it is prudence. Buffett also underscores the importance of human behavior in risk. Markets are not purely mathematical constructs. They reflect emotions, biases, optimism, and fear. Bitcoin amplifies these traits because its value is belief-dependent. Rapid rises encourage overconfidence. Sudden falls amplify panic. Investors who understand this can act with caution, avoiding the psychological traps that speculative manias set. Those who do not may find that even a technically brilliant asset cannot protect them from emotional error. He reminds investors to consider not only the potential gains, but also the psychological and financial resilience required to hold an asset through volatility. A single large swing can create panic, erode confidence, and lead to decisions that compound losses. Bitcoin's very structure, with extreme volatility and reliance on belief, magnifies these risks. Buffett's wisdom is that the most important question is not how high can it go, but can I endure the lows? Survival, after all, precedes profit. Buffett's lessons are timeless. Invest in what you understand, focus on tangible value, respect the forces of human psychology, and measure risk through the lens of durability rather than excitement. Bitcoin embodies fascination, innovation, and cultural significance, but its lack of intrinsic production, its dependence on collective belief, and its sensitivity to volatility create vulnerabilities that cannot be ignored. Buffett's calm, measured voice emphasizes understanding over hype, preparation over speculation, and prudence over emotion. In conclusion, the wisdom he imparts is simple yet profound. Wealth built on fundamentals endures. Wealth built on belief alone is exposed. Bitcoin may continue to rise, continue to innovate, and continue to inspire. Yet the principles that govern markets, human behavior, and enduring wealth remain constant. Observing history, measuring risk, understanding the nature of production, and preparing for inevitable uncertainty are the qualities that distinguish the successful investor from the speculator. Buffett's warning is not doom, it is guidance. An invitation to reflection, and a reminder that calm, patient reasoning, grounded in reality, will always outlast fleeting excitement. And as the narrative winds to its close, the final thought echoes Buffett's philosophy. The true measure of an investment is not in headlines, social media hype, or momentary profits. It is in its capacity to endure, to provide, to remain stable when others panic, and to produce value that transcends speculation. Bitcoin fascinates and captivates. It dazzles and excites. But enduring wealth, Buffett teaches, is always grounded in clarity, patience, discipline, and reality.